Hello, I'm Mitch Goldberg. You're watching Be the Boss of Your Money. Thanks so much for joining me. Your time is very valuable. It's precious. And I appreciate that you're spending some of it with me. My only hope here, my goal every day is it's to bring you value. That's what today's all about. And speaking of value, I don't know. I thought I had some good lead into that. Speaking of value, we're going to talk about inflation. What is it? What happens when inflation goes up? And how does it affect your net worth? And what type of investments could people consider in times of rising inflation? Certainly that goes along with saying what could get hurt during times of rising inflation. And is the worry about inflation much ado about nothing? So let's get into this, an important discussion we're going to have. Let me roll the quick intro. We're just getting started. If you have any questions, ask me in the comments. I love answering your questions. I love hearing from you. It's my favorite part of the show. And, let's get the ball rolling. Thank you so much for joining me. Again, I'm Mitch Goldberg. If you're just joining us now, we're just getting started. We've got a couple of things to talk about. Inflation assets, what could do well in periods of inflation? Should you be making any changes to your portfolio? There's evidence of rising inflation, but a lot of experts are still saying it's much ado about nothing. So what's the story on inflation? We're going to find that out. I'm going to give you those answers. We're going to talk about what you could invest in as far as inflation goes, and we'll talk about how that could impact stocks, your net worth. There's, inflation. I have a definition for it. You might not like it, but it's something that needs to be said. And what else? We're going to talk a little bit about the GameStop saga, and I have a question to answer from my friend Josh. Josh, I hope you're watching. If you are, let me know. Say hello in the comments. And, if you're not watching, I'm going to answer your question, and I'm going to call you up later and say, did you like my answer? And you're going to go, oh, yeah, it was great. And I'm going to say, it was about how I related Mickey Mouse and Fred Flintstone. You go, oh, yeah, it was great. That was great. And then I'm going to say, I never did that. You didn't watch. So I'm going to trick you like that, unless you're watching, of course. So a couple of things. And not only am I going to name investments, I'm going to name an oil stock right now that I'm so bullish on. I'm recommending an oil stock right now. The name of the company is, I'm just kidding. I'm not making a recommendation on an oil stock right now, but that one is for you, Debbie. I know you're watching, Debbie in Houston. I hope that made you laugh. All right. Just thinking of you. That's based on our conversation earlier today. So here's the thing. Did anybody watch the circus today? That was the whole Congress, the House panel, I guess the finance panel, drilling the CEOs of Citadel and Robinhood. Did you guys see that? And talking to the this young fellow, I forgot his name is something Kitty. It's on the tip of my tongue. I've read it a million times. Who's on Reddit and was touting the heck out of the stock. I know that as a professional, there are rules I have to follow. I can't go on Reddit in some chat room, any chat room, and tout a stock. That's so against the rules in the industry. It's just, but other people could do it. I watch a lot of the people in the media as well. I should say the media. I have no kick against media. I was like, a lot of the YouTubers and bloggers and all that, and vloggers who are doing this personal finance stuff. It's one thing to talk about budgeting and debt management, but when they start getting into securities and markets, and even though they say this is just my opinion, and then they go on and talk like they're making a recommendation, I wish I didn't have to follow the rules that I have to follow, but the rules are there to protect the public. That's what they're there for, and they work because there was a time when financial advisors could say anything and do anything, and that was partially blamed for the stock market crash of 1929, and markets stay down until World War II. And, there are rules in place that we can and cannot do certain things. Okay, so brother, if you're out there, you have a question, ask me in the comments. So the circus today with GameStop, I could have explained the whole thing that happened with GameStop in like 5 minutes, but instead the representatives that were asking the questions, they would ask like this long-winded, like 60-second to 120-second question. Seemed more like a commercial. But they ask this long question. It seems like a commercial, and then they say, and just answer me yes or no. I'm like, whenever somebody asks me a question and they go, just yes or no, what I say to them is, you can ask me anything you want, but you cannot choose the words that I may use. You cannot tell me what I can and cannot say. You got it? Because if you're going to tell me what I have to answer you, if you're going to tell me what words I have to choose, the conversation is over. So I'll give you my question because it's more nuanced than yes or no, because clearly when you ask me a yes or no question on such a complex subject, it's clear that you really don't know what you're talking about. But if you just give me a chance, I can educate you so that you can actually ask me a more informed question so that you can get an informed answer so that you could make your own informed decision. Doesn't that make sense? Yes or no? I'm like, you could answer that any gosh darn way you like. My conclusion on this whole GameStop payment for order flow, that whole thing, it's a waste of time. It's a huge distraction. It has absolutely nothing to do with your personal finance. Nothing. You go on and you do what you do, spend less than you make, save money, invest every pay period every month. That's what it takes to build wealth over time. This whole big this whole big shindig with GameStop means absolutely nothing to 99.999% of investors out there. It's just a sideshow. It's just something to talk about. It's something to beat the drum with until we get to the next big thing. It's all about the circus. All right. As Gary Vaynerchuk says, based on the people I saw today on asking the questions, the Congress people, we're all still in high school. All right. Now I'm going to answer the question from my friend Josh. So we have somebody out there. We have Bonnie. Hey, how are you, Bonnie? Thank you so much for joining me. Really appreciate that. Thank you very much. So to answer the question, my friend Josh asked me a question. They're talking about investments around the dinner table, which is a great thing to do. And I think it's great to talk about this in personal finance and investing with your kids at the table. A lot of people, it's private. We don't talk money in front of the kids. I don't get that. I think you talk money in front of the kids because the kids will become adults one day. And why should they have to wait until they're older to start from scratch? Give them a head start. Let them learn from your mistakes. Let them learn from your victories. Let them learn. Let them learn. Very cool. Thank you, Bonnie. The question is, Mitch, what's the difference between index funds and mutual funds? And which one is, I don't know. We didn't really ask which one is better, but there's really no way to say which one is better. Let me tell you what the difference is. Yes, Bonnie, it is very important. The difference between index funds and mutual funds. So let me explain. First of all, an index fund is a passively managed fund. Now you cannot invest directly into an index. I know, well, but if I invest in the S&P 500 index fund, isn't that investing in the index? No, it's not exactly the same. Index funds have some fees, expenses. They're not always identical to the index. There's sometimes a little bit of tracking error, but you could invest in a security that tracks or mimics an index like an S&P 500 index fund. So to say what it is, all index funds are either mutual funds or exchange traded funds. So we're getting a little bit more into the weeds here, but that's a good thing. An exchange traded fund is like a mutual fund, except an exchange traded fund trades on an exchange, like let's say the New York Stock Exchange, and it trades all day like a stock. You could buy it and sell it all day long. And every time you put money into an index fund, that's an ETF, an exchange traded fund, it creates new shares, and you're just getting it at that price. So you don't have to worry about built-in capital gains taxes, generally speaking. Okay. With and a mutual fund, it's also like a package product, like an exchange traded fund. It's a package of stocks, like S&P 500 stocks. But just with a mutual fund, you can only buy it or sell it at the closing price of the day, at the 4:00 p.m. price. So an index mutual fund or any mutual fund doesn't trade all day like a stock. It's just, the fund you see in the morning, it's, let's say, $10 a share for the mutual fund. It'll stay $10 all day long. At 4:00, the price will change depending on the value of the securities of the stocks that are actually in the fund. So index funds are mutual funds or exchange traded funds, but not all mutual funds or exchange traded funds are index funds. You could have a mutual fund that tracks emerging markets. Well, I guess that could be an index fund because there's emerging market indexes. But you could have a mutual fund that is managed by a fund manager who likes to pick the stocks that go into the fund. So that's not passive, that's actively managed. Passive means you're just mimicking an arbitrary index that's already been created. You just have to mimic it. You don't have to put any time or effort into research or any money into research because you're just mimicking an index. But a mutual fund could be an index fund. It could just say, we're a mutual fund. We're going to call ourselves the XYZ S&P 500 index fund, and we're just going to mimic whatever we see, whatever is in the S&P 500 index, for example. And because we're just mimicking, we could keep the expense ratios really low because we're not paying a whole staff for research. So that's what an index fund is. And they're generally very inexpensive, very low expense ratios. Actively managed means that instead of just tracking an index, there's a fund manager who will go out of their way to research stocks and pick certain stocks. Like maybe they'll just focus on growth companies or value companies or technology stocks or smaller companies. So that's really the difference. An index fund is a mutual fund or an exchange traded fund, but an exchange traded fund or mutual fund could be an index fund, but it could be a lot of other things as well. So that's the difference between an index fund and a mutual fund. Index funds are mutual funds or exchange traded funds, but not all mutual funds or exchange traded funds are index funds. I hope that helps, and we could certainly speak more about that. On to the topic of the day, inflation. And it's starting to bother some people. And when I say inflation, let's just generally talk about inflation, just the general rise in prices. When you start to see consumer staples, you start to see milk and soap and shampoo and clothing, and you start to see a general rise in everything, and then in prices of everything, and then you go to the supermarket and you spend $100, and you're like, wow, I didn't even get that much stuff. I feel like I'm getting less and less stuff at the supermarket. That's inflation, where you're like, wow, it now costs me like $50 to fill up my tank of gas for my car. That's inflation. Okay. Inflation is like, it's like high blood pressure, the silent killer for your money, because it's usually incipient. It's usually gradual. You usually don't notice it that much, and it's kind of tolerable until one day the damage is done and the dollar has gotten so weak and it can't buy a lot of stuff like it used to. So that's how I define inflation. Your dollar doesn't go as far. And there's pockets of inflation. We call it asset inflation because inflation is taking place in the stock market going up because there's no place to put your money, right? Because I talk to baby boomers all day long who are retired or they want to retire and they're like, I can't get anything in the bank. I get like a 0.01% for my, $1 million plus in the bank. What am I going to do with that? So they're not forced, but they feel extremely, very strongly compelled to put their money in the stock market because at least they're making something in the market. They're getting some dividends and they think that's a good thing to do. I think it's actually, people could get carried away with it, but when they do it and the stocks go up, it validates the decision. They feel smarter for doing it and they want to do it more until people get so heavily invested. And then finally the market goes down and then people are scratching their head saying, what the heck happened? Okay, by the way, Steve, I see you out there. Thank you for joining me. And Ron, I see you out there too, buddy. Thank you. And I can't see you. I mean, I could see that you gave me one of these on the stream. So I really appreciate that. When Ron gives you a thumbs up, it's a strong thumbs up because he's like, he's all jacked up. Okay. And he's a residential real estate broker in my area too now. Cool. So what happens with inflation? That's asset inflation. Oh, and the price of houses go up. So where do you put your money? You put your money into real estate. So the prices of houses have gone up because interest rates are low. So low interest rates pushes baby boomers into the stock market, and it pushes savers into the stock market of all ages, and it pushes people into buying homes because even though the price of houses go up and up and up, the rates are so low that it's still not crazy expensive in terms of the monthly mortgage payment. But that's asset inflation. The inflation that we're really worried about when we talk about inflation is the stuff you buy at the supermarket. It's the clothing you buy. It's all that stuff. Right, Bonnie? You're getting me. We are like, simpatico. Thank you. So we're all worried about that. Now, there are a number of stocks you could handle, but what gives me this worry about inflation? So let me just do a quick share screen. Put myself in here, okay? Put myself in the lower right-hand corner. There I am. You see me? Lower right-hand corner, okay? So as you can see, the Dow off 119, S&P off 17, NASDAQ off 100, Russell 2000 off 38 points, down 1.67%. But stocks were down a lot more earlier today. Stocks actually have recovered a little bit, and they keep recovering when they go down the last few days because, the Fed keeps coming out and says, we are waiting until we see more inflation, and we think we've got a long way to go. But Warren Buffett's Berkshire Hathaway raised its stake in Chevron. He took a big stake in Chevron, okay, as well as Verizon and other stocks. All right. As far as interest rates go, why is the 10-year yield going up? Okay. Did we switch screens on? Are you seeing the screen I'm seeing? I feel like the screen is stuck. All right. Well, it's not quite the share screen I want you to see. Now I'm looking at Bitcoin. Now I'm looking at the market again. All right. So let's talk about Warren Buffett bought big stake in that. Not. Come on, guys. Not Bitcoin. Let me stop sharing the screen for a second. So let's talk about inflation and what that does. Basically, your money just doesn't go as far. And if you don't own assets like stocks and real estate, you're really screwed. I mean, you're really because now you have no way to make up the difference between paying more for everything. Because if you're paying more for things, at least you own other assets that are going up in price. So what we need to do is figure out where you could invest based on inflation. And there's a couple of things that we could take a look at, and now good, they're right here. Okay. So let's start by taking a look at gold. This is the Spider's Gold ETF, GLD. This hasn't been doing that well if people are worried about inflation. But there's a funny thing going on with gold, where gold has always been the inflation hedge that you go to first. So when you see gold going up, that means there's inflation. But it seems like there's a replacement, and that replacement for gold seems to be Bitcoin at the moment. And I say at the moment because I don't know how long this is going to last, and Bitcoin is a very new phenomenon. Gold has been around for thousands of years. But people are looking to own something as a hedge against inflation that has a limited supply, a finite amount that people believe has value, and that could be exchanged for other things or services of value. And although Bitcoin doesn't fit that definition perfectly, it's creeping little by little to fit that definition. So I think a lot of gold bugs who would be betting on gold for inflation are actually swapping into Bitcoin. But gold is typically something you want to own, and gold miners when there's inflation. The next thing is TIPS. You see this on my screen? This is one ETF. It's probably the biggest TIPS ETF. TIPS stands for Treasury Inflation Protected Securities. And I think these are better in IRAs, but basically what they do is they pay a little bit of interest, but the price is adjusted to keep your money level when inflation rises. And when that happens, it does create a small taxable event, which is why a lot of people like to own these in tax sheltered accounts. The next one is FLOT. This is another ETF, but these are good proxies for the asset class. But floating rate bonds are bonds that basically track a certain interest rate when interest rates go higher. So these will continue to pay you. And if you notice, FLOT, okay, is right near its high. You see that in the corner there, 5110. It's right near its high. And you see gold is a pretty far distance off its high. It's almost exactly in between its year high and year low. So gold has not been showing us any worry about inflation. And then there's real estate. This is one of the ETFs I track for real estate. It's the Spiders ETF IYR. Real estate hasn't exactly been doing so great either. But typically speaking, real estate is a hedge against inflation because as inflation goes up, rents go up, the yield goes up, the dividends that they could pay out go up. Now, real estate has had a big problem basically because of commercial real estate and because of the pandemic and empty office buildings, things like that. But if you believe inflation is coming, that is typically historically a place to be as a hedge against inflation. And then there's energy. And I bring up energy especially now because this is Warren Buffett's thing. He just recently purchased a large increase of stake tremendously in Chevron. But if you notice, oil was negative per barrel almost a year ago. It was like negative 40 cents a barrel. And now it's like, close to 60. So oil is going up because the economy is reopening. And as the economy reopens, more people are traveling, more people are flying, more people are driving, more fossil fuels are being used up. So those are typically your hedges against inflation. There are a few other things out there, but yesterday retail sales came out way higher than expected, over 5.5% versus expectations of 1.3%. And the producer price index number came out yesterday, the highest since 2008. It's just a blowaway number, 1.3%. You wouldn't annualize 1 month of figures, but if you do annualize it, you're talking about a pretty significant drive in inflation. Base case has been the economy picks up, more stimulus comes out. I mean, at this point, it's actually somewhat debatable if so much stimulus is needed based on the PPI number and retail sales. But we get stimulus coming out, $1,400 per family member. So you're talking about and the $600 stimulus, you're talking about giving a family of four who makes under $150,000 a year, $8,000 cash to go out and spend. That is one heck of a boost. And you multiply that by families all around the country, that money's going to get spent. Okay. Yeah. Some of it's going to go into the stock market. Some of it's going to go into savings, but a lot of that's going to go into spending. So that's what gives me reason to believe inflation is on the way. The Fed disagrees with me. Chairman Jerome Powell, Fed Chair Jerome Powell, he says he's going to keep interest rates ultra low until the labor market really heals to what it was before the pandemic. And he says he'll accept higher, longer term rates because you won't just say, oh, we're over 2%, our target rate, long term rates, you have to raise rates. He says, well, I'll average it out over several years. He's telling you that he's going to let the yield curve steepen, that he's going to keep rates, short term rates low, longer term rates are going to go up. And that is great for bank stocks. I did make a couple of comments recently about energy stocks. I just want to show you this real quick. Take a look at this. I think it's good. This is something I said about oil stocks. As the price of oil goes up and there's so much capacity, so much excess oil, mostly because the economy got so weak that the demand for oil and gasoline plunged because of over drilling. We're in a fight between the shale drillers domestically, Saudi Arabia, Russia. So there's just a battle for market share. But now that the economy is coming back and a lot of producers have failed, we've probably seen more producers in energy fail in the last year than ever in history. We have. So that means that the stronger producers have survived. They've managed to clean up their balance sheets. They've managed to make more with less. And now that energy is coming back, you have to take a look at the low P/E ratios of a lot of the energy stocks, like a Chevron, for example, and you have to take a look at the dividends that these companies are paying. And you've got yourself what appears to be not just down and out stocks, a down and out sector, a value play. You have a catalyst in the form of rising earnings now because of the rising price of oil. So that's my story. I'm sticking to it. So there's gold, tips, treasury, inflation protected securities, energy, banks, REITs, floating rate bonds. There are ETFs, exchange traded funds, for all of these. So they're pretty easy to find. If you want more information about it, you're certainly welcome to reach out to me. And I don't want to get so into Bitcoin. I think there's still a lot of conceptual, philosophical things with that. That's a story for another day, which we already talked about that. But I do think that a lot of gold bugs are moving money into Bitcoin because they think that will be a better hedge against inflation than gold. But I also think that once something goes up a lot, people start buying it because it's going up and everybody else is making money, and it becomes like a FOMO, fear of missing out trade. And then that's what momentum is all about. So that's not really my thing. I don't mind momentum stocks that trade on momentum. As long as I own the stock before the momentum started, then, I'm totally cool with it. Okay. Thanks so much for watching. I will see you Monday.